All right, breakaway gaps. An alternative to market maker buy and market maker sell model reading. A couple of things to talk through. So I'm gonna go through the study when to use them. So right now I'm finding good success in backtesting and measuring moves that I anticipate to reach somewhere and then reverse. Or potentially measuring a move that seems very aggressive and getting confirmation if it actually will reverse, and using it like all tools in the ICT toolkit for inversion. All right, have to be careful not to form fit this thing, and the measurements I'm going to be using are the 1 and the 1.5% deviation. So basically, when price gives this move, let's say it's bearish, and we see a swing high, a breakaway gap, and we want to measure this move, we take a Fibonacci and we anchor it to the top, the nearest swing point to the breakaway, and then mark the 50% of the Fibonacci to the 50% of the gap. So a breakaway gap will either be completely unfilled or partially filled, but it should not be completely filled, hence breakaway. So by plotting at 50%, we'll have the range, and then we'll have these deviations. And so if this range runs out to 1, so that's 1 full range, and then we want to look for the 1 and the 1.5. So pretty straightforward, 1 full box down, and then the 1.5. So that's the 100 and the 150%. Okay, the ideal is that we want to, in a good situation where it will reverse, see that price will clear, sweep, and then retest. So for example, it will get here, come back, get here, up, back into the range, and then here's where we'll see either true shift, or if we just fill the rest of that, come back to a part of it and then go down. So in the sense of a market maker model, we can either be on the buy side of a sell program, or we can be on the buy side of a buy program. So the buy side of a sell program is going to simply continue lower. So leg B is the buy side of a sell program or sell model. Or if this does not fail, then we are on the buy side of a buy model. And so we're evaluating that. We'll look at a couple of examples. So we'll always be super aware that we want to avoid form fitting. So let's take a look at this week. So this week was chopping around. We had a Monday high, we created a Tuesday low, price got back inside of Monday's range, ran higher, failed to break Monday's high. Okay, so on Thursday and Friday, we're anchoring on the idea that this is going to be a Monday high of the week. We get into this particular day and we see if it's a Monday high of the week, then we're looking for bearish. So any bullish runs, we want to see, will they hold or will they fail, right? So on the time frame that we choose, we're looking at this bullish run and we're asking the question, where do I want this to go if I were expecting it to be bearish? Well, I expect it to go to the London range high. How can I confirm or use a measuring gap to see when this price run has concluded? There's other things that you could use, but the measuring gap is just one more tool in the arsenal. So we have a swing low and we have a gap, and we take our measurement from that low. We want the 50% to land right at the 50% of the gap. And we're using the measurements of 1 standard deviation and 1.5. Now the expectation is that as price makes its way up, as price makes its way up, we want to see how price reacts to these levels. Now at the time, the only thing we would have had is the gap and the low. So we don't see price above here. Now we expect, or we would like to see, the terminus on this run ending at London's high. That's an expectation, but we need to see how do we confirm that. So as we're looking at this gap, as we're looking at this price run, we can see that this breakaway gap has no fill. It reaches here, let's say, and we start our measurements. None of this price action has formed as yet. We just have a expectation and anticipation that price will reach this level. Now that level is above the 1 standard deviation, but take a look at how price uses these levels. So we expand, we clear the first standard deviation, we retest, we expand, we retest the 0.5, we expand, we reject for the first time after the 0.1 or the 1 standard deviation, we break it to our expected terminus, and then we start to see price breaking down. Now at what point, or at some point, it is no longer making step moves higher. And now what we see is price starts to make moves lower. So here at this level, we don't know if this will truly break or hold. So as price falls below this and we see that it is failing to break above that deviation point, we can use that as a narrative builder to say, okay, have we concluded this buy run? And so as price starts using those levels again and breaking down, then we can use that information paired up with time to see at anchoring points. Okay, another example is here. So we want to have a narrative of bullish or bearish. And so I'm looking at this one now, and what we had was a price run coming down to a level. I wanted to see it get to the 50% of this, whatever this is. And we had a high, we had a breakaway gap, we had the expansion. And now we have price getting to that terminus, breaking above the 1.5 deviation, retesting, breaking above the 1, retesting, breaking above the 0.5, retesting. And so it is using the same levels on the measuring side like a market maker model. The question becomes, is this the buy side of a sell program? Are we just in the buy side of a sell, or are we in the buy side of a larger buy program? So that's going to be the entry for today. Just continuing to add little bits and pieces to this. Cool. We'll do it again.